Hey everyone. So today we're talking about cash is back and should I put my money in a money market fund? Um, you know, I think we should start with a question of is it smart to do that, or is there something better that's possibly hiding in plain sight? So I'm Cary Smith and I'm sitting here with Amar Shah. Amar and I are both with Client First Capital. And so, Amar, let's dig in. Let's talk about cash is back and how should we, how should we react?
Yeah, we'll cover the pros, the pitfalls, talk about money market accounts and what's really good right now. I think uh, we have to look back over the last 30 years and recognize we've historically been in all-time low interest rates. And so when interest rates were low, uh, taking to get any type of return, you had to take a lot of risk,
That's right.
right? Money market funds, at least for the last 6 months or longer, have been paying anywhere between 4 and 5%. Um, some were as high as 5.2. And so for the first time in over a decade, cash is actually earning real returns. And I think
Right.
that's a big takeaway here is that we've gone from negative returns when you look at it relative to inflation to real returns. And that with the backdrop of we're like less than a percent or so from all-time highs again. It's amazing to say that after like a 20% decline and then and some incline. Uh, let's just call it choppy volatility. That yeah, maybe looking at a money market fund, looking at some structured products, maybe something that's important to do at this point.
Yeah, I think so. So let's talk about maybe just real quickly for someone out there who's watching who may not know. Let's define a money market. What is
Yeah.
a money market fund?
Well, a money market fund is basically a short-term commercial paper, right?
Mhm.
Government or commercial paper. So, they're taking your money and they're making these micro loans of 7 days, and they're making a spread, and you get a higher interest rate. So the yields are attractive compared to savings or CDs, but oftentimes you get 1 day access, right? Like there's a daily liquidity, right?
Okay, right.
So I think the thing that difference that you got to be aware of is that it's not FDIC insured, right? So it falls under SPIC insurance, which if you guys remember in 2008, money market funds broke the buck, and so your your 100,000 in savings was worth 98,000 for a couple of days, and then it went back to 100,000, and that's when the volatility was at an all-time high with those type of debt securities.
Yeah, you touched on something that I think is important in mentioning that it's not FDIC insured. And the reason I think that's important because a lot of people are thinking about money markets when they're looking at what they're earning in a savings account, right? And they're looking to not take on risk, but also see if they can get a little better interest. And a lot of times money markets can do that, but you make the point, but you may be, you'll be losing the FDIC insurance that someone has with the bank.
Yeah, I think and that's important to put in the consideration set because there is some money that you want for emergency funds that you
Mm-hmm.
probably want the FDIC insurance, but you don't need to have all your eggs in that FDIC insurance bucket, right? You can
Right.
take, the spectrum of risk is, let's say, here, and you're just going like one sliver over, right?
Okay.
So, um,
And then you said this, but I'm going to just say it a different way. But so money market funds are typically low risk and invest in high grade short term interest instruments, right? And so the fact that you can get a decent return, 4 or 5%, I think you said as high as 5.2%, is with very little risk can be attractive to a lot of people.
yeah, I think so too. And I think the next step of this conversation is so that's money markets, right? But a lot
Mm-hmm.
of products are based off of money market rate funds in
Right.
order to give you your total return. So it's a component of your total return. And so when we're talking about these, one thing that comes to mind is investments like structured products, um, options related contracts. Remember to get zero risk, 0% on your cash, and then you're buying options and stuff like that. Your total return was between 2 to 4%. Well, now you're layering another 4% onto that because of the cash. So now you're looking at 6 to 8% with low risk, low downside. So those type of investments become more attractive relative to investing in the S&P or Nasdaq when we're hitting all-time highs, when we haven't had tariffs solved. There's all these uncertainties, right? The Fed hasn't reduced interest rates. I mean, there's a lot of there's more uncertainty today about the future than there was, a while back, right? And so, um, you know, coming off a all-time high, carving some part of your portfolio out to have some cash so that you could weather any potential storms that may be coming may be a good idea. And it doesn't have to be money market. There are some products that allow you to participate in the market with no downside, right? And you may look at that as an option.
Well, so you touched on volatility a little bit, and for some people, when things are as volatile as they are today, um, it's it spooks them a little bit, and they're looking for something relatively safe. Can I, where can I go to get some, decent returns? Not in the long run, but while we kind of weather this volatility storm, right? And so this may be a good option for that, or a good place to consider.
Yeah.
It's typically, money markets typically aren't great for long-term growth in your portfolio, but can be a place to park assets for a little while, or to park, maybe what you're going to need over the next, 12 to 18 months to live off of, if you're already retired and you're not still accumulating.
Yeah. So there's many reasons to have money markets or structured products to be a portion of your portfolio, right? You
Mm-hmm.
have to identify what's right for you. And in that, looking at it being a position that you hold maybe for a short term until you have some more certainty or you have a better idea of how you want dollars to be allocated. In fact, like if we look at our fund that we run right now, we have roughly about 25% in short-term cash instruments. And the reason for that is that there's a high degree of uncertainty, right? We went from risk on to neutral, right? And in that, we're waiting for better opportunities. We can't find, everybody's looking for the best, return for every unit of risk that they're taking. And we're not finding those opportunities as much as or as frequently.
Yeah, and what we are finding is, a lot of the opportunities are out there. It's just the risk is so much higher right now, and it just doesn't make sense to take on unnecessary risk, especially when there's a very viable option.
Yeah. Yeah. So, you get 4.5%, let's just say that's probably about 80% of the long-term average return of the market, right? Like, so like,
Right.
not 80%, but like 60%, right? So
Yes.
we're getting there. We're getting most of it. And, who knows? These data may change later on and we may pivot, but I definitely think that when we look at where we are and the amount of risk that we're taking, that money markets, structured products, anything that's correlated to short-term interest rates should be something that you're considering for a portfolio as a piece of the overall pie, especially in retirement.
That's right. Okay. All right. As we wrap this up, any last thoughts? I have maybe a closing comment, but any last
Yeah.
thoughts on this?
No, I think we summarized it pretty well here. That's part of your portfolio, your overall portfolio, and if you like our content, or why don't you do the summary here?
Okay. All right. What I was going to say real quick, Amar, was so cash is back. Cash is not really a strategy, but it is a tool, right, that you can use in your portfolio. And now's a really good time to consider that. But I would say if you're out there and you're thinking about this, or you're thinking about your portfolio and you would like to have a conversation with someone, reach out to us at clientfirstcap.com. We would offer a free consultation with anyone who wants to chat about their portfolio or other financial planning topics. Also, if you like this video, give us a like. It helps other people find our content. And again, you can connect with us at clientfirstcap.com.